Hello everyone, welcome to the market opening bell for Wednesday, March 11th, your 10-minute guide to the stock market. US President Trump stated that the war with Iran may end soon. The US Energy Secretary mentioned that they are considering selling strategic petroleum reserves and coordinating with other countries. Following the rebound in overseas markets, Hong Kong stocks rose on Tuesday. The Hang Seng Index opened 331 points higher. The gain narrowed to 203 points at one stage, hitting 25,611 points before widening again. It eventually closed at the day's high of 25,959 points, up 551 points or 2.2%. The Hang Seng China Enterprises Index rose 128 points or 1.5% to close at 8,710 points. The Hang Seng Tech Index gained 118 points or 2.4% to close at 5,060 points. Total market turnover reached 330.9 billion Hong Kong dollars. Southbound trading turnover totaled $151.8 billion, while Southbound funds recorded a net outflow of $17.953 billion. Southbound funds net purchased Tencent for $3.648 billion, Alibaba for $1.332 billion, Yangtze Optical Fibre and Cable for $150 million, and Yangtze for $104 million. On the selling side, they net sold the tracker fund for $13.56 billion, the Hang Seng China Enterprises Index ETF for $5.379 billion, the CSOP Hang Seng Tech Index ETF for $3.571 billion, Xiaomi for $255 million, and SMIC for $252 million. According to statistics, Southbound funds have been net buyers of Tencent for 8 consecutive days, totaling $14.539 billion. Mainland China's foreign trade data came in strong. The three major A-share indexes opened higher and continued rising, with gains expanding in the afternoon. The Shanghai Composite Index climbed back above the 4,100-point level, closing up 26 points or 0.7% at 4,123 points. The Shenzhen Component Index rose 286 points or 2% to close near its high at 14,354 points. The Chinese index surged 97 points or 3% to close near its high at 3,306 points. Total turnover in the Shanghai and Shenzhen markets combined reached 2.4 trillion yuan. The renminbi central parity rate broke through the 6.9 level, quoted at 6.8982 per US dollar, up 176 basis points from the previous trading day, the highest level since April 25, 2023. Data released by the General Administration of Customs showed that in February, China's goods trade import and export value increased 27.7% year-on-year, but fell 13.9% month-on-month in US dollar terms. Exports grew 39.6% year-on-year, but dropped 15.9% month-on-month, while imports rose 13.8% year-on-year and declined 10.7% month-on-month. The trade surplus was $90.98 billion US dollars. For the first 2 months of the year, total import and export value rose 21% year-on-year. Exports increased 21.8% year-on-year, beating market expectations of 7.2%, while imports grew 19.8%, exceeding expectations of 7%. The trade surplus reached $213.6 billion US dollars, higher than the market expectation of $176.1 billion. However, despite the strong start, whether such high growth can be sustained throughout the year remains to be seen amid escalating geopolitical conflicts and external uncertainties. On the Hong Kong market, the OpenClaw concept stocks continue to be actively traded. MiniMax broke above the 1,000 mark 1,000 Hong Kong dollar mark, surging 22.4% to close at $1,220. Alibaba rose 3.7% to $133.5, while Tencent jumped 7.3% to $553.5. Yangtze Optical Fibre and Cable soared 24% to close at $176.8. The company earlier stated during an institutional survey that, based on its forward-looking insights into the evolution of global digital infrastructure, it has developed a full optical network solution centered on AI, new generation optical fiber, and oriented toward intelligent computing infrastructure, featuring three supers: ultra-large capacity, ultra-low latency, and ultra-low loss. South Korea's SK Hynix announced that it has successfully developed the world's first 16GB LPDDR6 DRAM memory product based on its most advanced 6th generation 10nm class process. The Southern SK Hynix 2x ETF 7709 surged 22%. The company said it has completed the development verification of this product and plans to fully complete mass production preparation in the first half of 2026, with shipments officially starting in the second half. This will further enrich SK Hynix DRAM product line, optimize for AI applications, and consolidate its leading position in the high-RAM mobile storage market. LPDDR, low-power double data rate memory, has always been the heart of mobile devices, with its performance directly determining response speed and battery life. Compared with the previous LPDDR5X, LPDDR6 offers a 33% increase in data rate and over 20% reduction in power consumption. The 1C process node used by SK Hynix is its 6th generation 10nm class DRAM manufacturing technology. Compared with Samsung Electronics' current 12nm process, SK Hynix is clearly ahead in process miniaturization. This advanced process not only increases transistor density but also lays the physical foundation for lower power consumption and higher speed. CATL released its full-year results as of the end of December last year. Despite fluctuations in lithium prices and slower growth in the electric vehicle market, the company's profits still achieved explosive growth, with all key indicators significantly beating market expectations. Revenue reached 423.7 billion yuan, up 17% year-on-year. Gross margin improved to 26.27% from 24.44% in 2024, thanks to improvements in battery materials and higher recycling efficiency. Net profit rose 42.3% year-on-year to 72.2 billion yuan, with earnings per share of 16.14 yuan. The company proposed a cash dividend of 69.57 yuan per 10 shares, including regular dividend of 21.78 yuan and special dividend of 47.79 yuan per 10 shares. For the fourth quarter alone, revenue was 140.63 billion yuan, net profit 23.167 billion yuan, and net cash flow from operating activities 52.559 billion yuan. The 2026 investment plan includes major manufacturing capacity expansion. The Hungary base is expected to be completed by the end of 2025, and the Indonesia project will start production in the first half of 2026. At the results briefing, the company stated that since the second half of 2025, profitability has been solid due to high capacity utilization and economies of scale from increased deliveries. However, in early this year, the domestic passenger vehicle market experienced short-term sales fluctuations due to policy changes and the traditional off-season. The group believes that based on the long-term trend of rising global electrification penetration, the industry growth logic remains unchanged, and both the company and its clients are confident in the full-year outlook. Currently, production plans for the second quarter and the full year have not changed significantly, with capacity utilization remaining high. In addition, the recent lithium carbonate price increase is clearly weaker than the previous cycle. Combined with the company's significant achievements in technological innovation, product iteration, and cost reduction, its ability to absorb cost fluctuations has strengthened. The group also mentioned that it is accelerating the commercialization of sodium ion batteries, which have already been applied in some vehicles and lead the industry in overall performance. If lithium carbonate prices rise further in the future, the application scenarios and market penetration of sodium ion batteries are expected to expand further. NIO announced its 2025 full-year results. Total revenue reached 87.488 billion yuan, up 33.1% year-on-year. Losses narrowed from 22.658 billion yuan last year to 15.571 billion yuan, with loss per share of 6.85 yuan. The full-year adjusted net loss narrowed 39.4% to 12.414 billion yuan. In the fourth quarter alone, total revenue was 34.65 billion yuan, up 75.9% year-on-year and 59% quarter-on-quarter. Gross profit reached 6.074 billion yuan, up 163.1% year-on-year and 100.8% quarter-on-quarter. Vehicle gross margin climbed to 18.1%, mainly benefiting from scale effects, optimized product mix, and cost reduction measures. Net profit attributable to shareholders turned positive at 122 million yuan, compared with a loss of 7.132 billion yuan in the same period last year, with earnings per share of 0.05 yuan. Looking ahead to the first quarter of this year, vehicle deliveries are expected to be between 80,000 and 83,000 units, representing year-on-year growth of 90.1% to 97.2%. Total revenue is projected to be between 24.482 billion and 25.176 billion yuan, up 103.4% to 109.2%. China Resources Beer issued a profit warning, expecting 2025 profit to be between 2.92 billion and 3.35 billion yuan, a decrease of 29.6% to 38.6% from the previous year. This is mainly due to weak demand in the China white wine market, baijiu market, and contraction in consumption scenarios. The company will recognize goodwill impairment of 2.79 billion yuan to 2.97 billion this year related to the 223 acquisition of 55.19% equity in Guizhou Jinsha Liquid. Technical analysis, the Hang Seng Index has reclaimed the 10-day moving average at 25,930 points and is now set to challenge the 26,000 point level. The major resistance will be the neckline of the complex head and shoulders top at 26,300 points. The 20-day and 100-day moving averages are also currently hovering around 26,300 points, with support on any pullback at 25,600 points. Oil prices fell sharply on Tuesday as the market closely monitored the latest developments in the Iran conflict. U.S. stocks traded choppily. The Dow Jones fell by as much as nearly 300 points intraday, but rose as high as 479 points at one point, with a full-day range of 776 points. It ultimately closed down 34 points, or less than 0.1%, at 47,706 points. The S&P 500 index fell 14 points, or 0.2%, to close at 6,781 points. The Nasdaq Composite rose just 1 point to close at 22,697 points. The Fear Gauge Fix Index dipped 0.57 points, or 2.2%, to 24.93. The Nasdaq Golden Dragon China Index, which reflects Chinese concept stocks, surged 139 points, or 2%, to close at 7,222 points. The U.S. Energy Information Administration EIA raised its forecast for next year's domestic oil production, projecting that U.S. crude output will increase by 220,000 barrels per day to 13.83 million barrels by 2027. Meanwhile, U.S. Energy Secretary Chris Wright had earlier incorrectly claimed on social media that the U.S. Navy had escorted an oil tanker through the Strait of Hormuz, briefly deepening oil price losses to 19%. The White House later clarified that no such escort had taken place, yet oil prices still closed more than 10% lower. Oil majors Chevron and ExxonMobil each fell nearly 2%, while Shell dropped less than 1%. Chip stocks led gains in the technology sector. Micron and Intel rose 2 to 3%. Nvidia advanced more than 1%, the best performer among the Magnificent Seven. Meta also gained 1%. Adobe, which reports earnings this week, fell more than 2%. Software giant Oracle reported that for the fiscal third quarter ended February 28th, net profit rose 27% year-on-year to $3.72 billion. Adjusted earnings per share came in at $1.79, beating market expectations of $1.7. Revenue grew 22% year-on-year to $17.19 billion, exceeding forecasts of $16.91 billion. Cloud revenue totaled $8.9 billion, up 44% year-on-year, and above the expected $8.85 billion. Cloud infrastructure revenue jumped 84% to $4.9 billion, accelerating from 68% growth in the previous quarter. The company guided fourth quarter adjusted earnings per share to $1.92 to $1.96, with revenue growth of 19 to 20%, and projected fiscal 2027 revenue of $90 billion, topping market expectations of $86.6 billion. The stock rose 8% in after-hours trading. Our stock pick today is AB&B Bio Tech, stock code 2627. AB&B Bio Tech is dedicated to the research and development, manufacturing and commercialization of innovative vaccines, as well as traditional vaccines using new technological methods. Its vaccine pipeline includes both innovative products that meet domestic demand and comply with global standards, and traditional vaccines enhanced with new technologies. The company currently has two core products, the quadrivalent subunit influenza vaccine and the lyophilized human rabies vaccine, which is under development, plus another 11 vaccines in the pipeline covering multiple disease areas with substantial vaccination demand. The quadrivalent subunit influenza vaccine, being marketed under the brand name Huier-Kangxin, is designed to provide broad protection against two influenza A viruses, H1N1 and H3N2 subtypes, and two influenza B viruses, Yamagata and Victoria lineages. Compared with whole virus vaccines or split virus vaccines, subunit influenza vaccines contain only the key antigenic components of the virus and require further purification after viral disruption. This enables precise antigen targeting, delivering better safety and a lower risk of adverse reactions. As a result, subunit influenza vaccines are generally priced higher than whole virus and split vaccines. The group's quadrivalent subunit influenza vaccine received NDA approval from the National Medical Products Administration in May 2023 for use in individuals aged 3 years and above, becoming the first and only quadrivalent subunit influenza vaccine approved in China. Using its own production facilities and sales and marketing team, the group launched commercialization in September 2023. The new drug application for the group's quadrivalent subunit influenza vaccine targeting children aged 6 to 35 months was approved by the NMPA in September last year, making it the first and only full population, full dose quadrivalent subunit influenza vaccine approved for marketing in China. In January this year, the new drug application for the group's trivalent subunit influenza vaccine for all age groups was approved by the NMPA, positioning it as the first and only full population, full dose trivalent subunit influenza vaccine approved in China. This product represents a major upgrade over traditional split virus vaccines, offering advantages such as comprehensive protection, high purity of antigenic components, and lower risk of adverse reactions. The group recently issued a profit alert, expecting revenue for 2025 to range from approximately 446 million to 493 million yuan, a year-on-year increase of about 71.8% to 89.9%, and a net loss of 157 million yuan to 197 million yuan, a reduction of approximately 23.9% to 39.3% from the 258 million yuan net loss recorded in 2024. Suggested buy-in price 57 Hong Kong dollars, target price $65, stop loss at $53.5. I do not hold the above stock.